You do not need millions of dollars to retire on dividends, and you definitely do not need to be a hedge fund manager. If your goal is a clean, reliable $1,000 per month in passive income, the game is simpler than people think. You need a specific amount of capital invested in a specific dividend ETF. Today, we are doing the full breakdown using SCHD. No fluff, no vague financial freedom quotes, just the math, the engine behind the ETF, and the real roadmap to get there. By the end of this video, you will know two numbers: the sticker price for $1,000 per month right now, and the patient price for the investor who lets dividend growth do the heavy lifting. Before we talk about the income target, we have to talk about trust. Because if you do not trust the engine, you will quit the first time the market hits a pothole. And dividend investing only works for people who stay in the car. SCHD's goal is to track the total return of the Dow Jones U.S. Dividend 100 Index. Do not think of that as a random list of high-yield stocks. Think of it as a bouncer at the door. Its job is to keep yield traps out. Here's a yield trap. A company is failing. Its stock price falls from $100 to $20. The dividend yield looks huge, like 8% or 9%. An amateur sees the yield and thinks, free money. Then the dividend gets cut or the business breaks and the investor loses the thing that matters most: principal. SCHD is built to avoid that pattern by design. The index starts with a broad U.S. stock universe and excludes real estate investment trusts. Then it filters and ranks companies using fundamentals. Here are the screens that matter, translated into plain English. Screen 1, no REITs. This is not a real estate is bad argument. It is a structured argument. REIT distributions are often taxed as ordinary income. Qualified dividends from regular corporations are often taxed at the lower long-term capital gains tax rates. So SCHD focuses on the type of dividend income that is typically more tax efficient in a taxable account. Screen 2, free cash flow to total debt. This is the safety valve. It asks a brutal question. Does this company generate enough cash to comfortably service what it owes? When rates rise, weak balance sheets get exposed. Cash flow keeps you alive. Debt can kill you. Screen 3, return on equity. This is the efficiency filter. It helps cut out zombie companies that just exist. You want businesses that can turn capital into profit without constant financial gymnastics. Screen 4, dividend history. To even enter the club, companies must have paid dividends for at least 10 consecutive years. That is not a guarantee, but it is a real stress test across multiple economic cycles. Now add the silent advantage most people ignore: the cost. SCHD's net expense ratio is 0.06%. That means if you invest $10,000, you're paying about $6 per year in fund costs. This matters because fees compound in reverse. A high-fee fund does not just take a little bit. It takes a little bit every year, forever, and that drag adds up into a meaningful chunk of your long-term outcome. So when you buy SCHD, you are buying a rules-based quality filter, a dividend consistency requirement, and a low-cost wrapper that does not siphon away your compounding. That is the engine. Now the number you clicked for. How much SCHD do you need to make $1,000 per month? Step 1, translate the goal. $1,000 per month is $12,000 per year. Step 2, use the yield. As of December 2025, SCHD's trailing 12-month distribution yield is about 3.74%. So the baseline math is simple. Annual income goal divided by yield, $12,000 divided by 0.0374, that equals about $320,856. That is the sticker price. If you wanted $1,000 per month in dividends immediately, based on the trailing 12-month distribution, you would need about $320,856 invested in SCHD. And yes, that number is big. But if your brain is screaming, "I am out," you are missing the point. That number is for instant gratification. It is the price for people who demand the outcome right now. Dividend investors play a different game because there is a second number, the patient price. This is where the concept of yield on cost enters. Yield on cost is not magic. It does not change the market price. It changes what your original dollars produce over time. If a dividend grows, the same shares you already own start paying you more. And SCHD has historically grown its distributions at a high single-digit pace over multi-year periods. Here's the story version. Imagine you invest $10,000 into SCHD today. At a 3.74% distribution yield, your first-year income is roughly $374. Now imagine the distribution per share grows. Year after year, the dividend rises. Your share count stays the same unless you add money, but the cash those shares throw off increases. 5 years later, your $10,000 might not be producing $374 per year anymore. It might be producing $500 or $600, depending on distribution growth and reinvestment. That is yield on cost. So the real question is not only how much do I need for $1,000 per month today, it is also how fast can I build a position that grows into $1,000 per month. Because if distributions grow, the required starting capital for the same future income is lower than the sticker price. And that leads to the real takeaway. The sticker price is about $320,856. The patient price is consistency plus time. Math is useless if the underlying holdings are garbage. So what are you buying when you buy SCHD? As of late, 2025, the fund holds about 102 companies, and the top holdings are not speculative story stocks. They are cash flow businesses with long operating histories. Top positions include Cisco Systems, Merck, Amgen, AbbVie, Bristol-Myers Squibb, ConocoPhillips, Coca-Cola, PepsiCo, Lockheed Martin, and Chevron. This matters for one reason. SCHD is built to be the opposite of a hype trade. Right now, the broad market has a concentration problem. A small group of mega-cap technology names can dominate index performance. When that trade is working, it looks unstoppable. When it breaks, it drags the index down with it. SCHD is not trying to win the most exciting stocks contest. It is trying to win the keep paying you contest. Let's break down the defensive logic by sector. Energy. Energy is about pricing power and inflation sensitivity. If inflation pushes energy prices higher, your cost of living rises. But owning profitable energy producers inside your income portfolio can partially offset that pain through higher cash flows and dividends. In SCHD, energy is a meaningful allocation. Consumer staples. This is the boring money. People buy beverages, basic food, and household products in good times and bad. That stability shows up in cash flow and in dividend consistency. Healthcare. This is demand that does not care about the economy. If the market crashes, people still need medicine. They still treat chronic conditions. They still buy therapies that keep them alive. Industries with inelastic demand can keep producing cash even when sentiment collapses. Industrials and defense. This category is not war hype. It is the reality of government contracts, infrastructure, and long-cycle demand. A name like Lockheed Martin is not a trendy narrative. It is a business with persistent demand and the ability to support shareholder payouts across cycles. Now, does this make SCHD risk-free? No. It is still equities. Prices move, distributions can slow down. Sometimes allocations become concentrated in one sector, like energy, and that can create its own volatility. But the point is this, SCHD is designed to load the portfolio with businesses that can keep paying, even when the market mood swings. That is the defensive shield. Now, let's talk about getting from $0 to $1,000 per month, because most people do not have $320,856 sitting in cash. So there are two paths. Path one, the $100,000 time machine. You start with $100,000, drop it into SCHD, and walk away. No tinkering, no timing, no waiting for a dip. You simply reinvest every dividend and let compounding do the heavy lifting. At SCHD's since inception annualized total return of roughly 12.31%, that single investment climbs to about $320,856 in just 10 years, the point where your dividends alone can fund a steady $1,000 per month. Path 2, the real-world DCA plan, $1,500 per month. Most investors don't have a six-figure check to drop. So you build the same outcome from zero, $1,500 at a time. You automate the contributions, reinvest the payouts, and let time do its work. At an 11% annual return, the account crosses $320,856 in about 10 years, roughly 121 months. It's the same finish line reached through consistency instead of capital. 10 years of discipline, and the snowball you built paycheck by paycheck now pays you every month. Here's why this path works psychologically. In a crash, your account value drops. Your brain hates pain. It wants you to sell to stop the discomfort. Distributions help because they give you a second scoreboard. Even when prices are ugly, the cash still hits your account. That income stream can keep you calm. It can keep you consistent. And if you are reinvesting, a lower price means your fixed monthly contribution buys more shares. That is not a side benefit. That is the mechanism. Dollar cost averaging into a dividend ETF turns volatility into a share accumulation advantage. So the roadmap is not get rich quick. It is simple. Build the base position, reinvest distributions, keep adding consistently, let distribution growth and time do the compounding. SCHD is not a lottery ticket. It is not a meme trade. It is a rules-based dividend ETF built around profitability screens, balance sheet strength, dividend history, and low costs. And $1,000 per month is not just a number. It is groceries. It is rent support. It is a buffer that gives you options. The best time to start building income was years ago. The second best time is the next deposit you make. Start with $500, start with $100, start with whatever you can do consistently. Turn on reinvestment. Stay in the game. And if you want the head-to-head comparison between SCHD and VYM, click the video on your screen right now.